Hey folks, welcome to a product review at Finominal. Today we're going to look at PutWrite and BuyWrite strategies. Now these funds use options in the portfolio construction process and have primarily two objectives. The first one is to provide lower risk than the stock market, and the second one is to provide a significantly higher yield than like the S&P 500. And from a yield perspective, we do see the yields of those four products ranging between 3% and 11%, which is of course significantly higher than what the stock market offers. So let's look at how these products have performed and what has driven them from a risk return perspective. And we're going to use a portfolio comprised of the S&P 500, which has a 60% allocation, and short-term US Treasuries, which has a 40% allocation as a benchmark. Now, before we go to performance, let's have a quick look in terms of how similar or different these strategies are. And so here we have effect exposure analysis that shows the affected betas over the last 9 years. And we can see that the betas of those four products, as well as the benchmark portfolio, are almost identical at 0.6, 0.7 to the S&P 500. So that means effectively these products, as per the objective, provide like a lower risk than the stock market. We do see that the factor exposure to other asset classes like bonds, commodities, and US dollar are all over the place. And the same thing applies to equity factors, where you have divergent exposures. Now, the one fund to kind of keep in the back of your mind is the one from First Trust, which has a higher beta, 0.7, and I'll come back to that later on. Now, from a risk perspective, these products are still driven by the stock market, and that's important to note because sometimes these are being marketed as alternative strategies or as diversifying strategies, but it's just diluted equity risk you're getting at a high yield, right? But so these are neither alternative nor diversifying. Moving on to performance, we do see the performance since 2016 in this chart. So we have roughly about almost 10 years, and we do see that there's one product, which is the one from First Trust, that the green line that has almost consistently outperformed the other three ETFs. Now, we can simply explain that by that ETF having a higher beta to the stock market, 0.7 versus 0.6. We also see that the benchmark portfolio comprised of the S&P 500 and US Treasuries, the red line, has outperformed all four products, despite offering the same beta, the same risk. So that's kind of interesting to think about. Now, if you talk about risk a little bit more closely, right, we can look at the performance of those four ETFs as well as the benchmark portfolio during periods of market turmoil, crashes, and so on. And what we do see here is, for example, the sell-off in 2022, COVID, 2018, and so on. But none of those ETFs has a consistently lower drawdown. The one that kind of like, is slightly worse on average is actually the one from First Trust, but it's as expected because its beta is simply higher. And we of course also see that the benchmark portfolio comprised of the S&P 500 and US Treasuries, that actually had significantly lower drawdowns during periods of market stress, despite offering the same beta. Now, that's kind of it from a return and risk perspective. We can, of course, pull that together and show you the Sharpe ratios. And the Sharpe ratios have been surprisingly similar. They range between 0.52 and 0.6 versus 0.93 for the benchmark portfolio, right? So that's a lot higher. And that kind of summarizes our review of these four ETFs. So they do provide a lower exposure to the stock market with betas around 0.6, 0.7. They do have significantly higher yields at, 3 to 11%, right? But you're paying a high price for that yield, right? Because you lose on return. And that simple portfolio, right, comprised of the S&P 500 US Treasuries had a much higher return, right, despite offering also much lower risk. And so that's kind of the way to think about these option-based products, right? There's not a lot of difference between BuyWrite and PutWrite, as we've seen. And yes, you are getting a high yield, right? But you're sacrificing your total return for return on capital. Hope that helps. Have a nice day.